Why am I talking about the stocks you should be investing in from 2028 to 2045? Well, because they're different than the stocks that you're going to make the big money on between now and 2028. Right now, we're building the infrastructure that is going to provide us AI, you and I, and the consuming public of the world, much as when we built the highway system in the United States in the mid 50s, the first we had to build the infrastructure. We had to get the bulldozers out there and move the dirt and put down the sand and the gravel and the concrete and the rebar before the companies like ExxonMobil could benefit from the traffic going down the highways, and then before Holiday Inn and McDonald's could benefit from the people who had to stop for night place to sleep, and so it's a different element, and that's what's happening with the introduction of AI. We're building the infrastructure. We're taking those GPUs and we're putting them in computers, and we're putting those semiconductors into data centers, and then the data centers are going to deliver us the knowledge, the concierge service of AI that we're going to experience from 2028 to 2045. And those are the companies you need to be building a position in now, so that when we get the infrastructure built and we start delivering AI, you can benefit from it. And they're going to give you some opportunities, because some of these five stocks price is probably going to pull back because all the money they're spending building the AI highway. And that's Amazon, Google, Microsoft, Meta, and Apple. So if we'll build a position in them now, they're going to pay off in the future. So if you're 20 years old and you've got a Roth IRA, you need to be building a position in these five companies so that your Roth IRA is worth millions of dollars. If you would have done it in 2004 to 2024, I'll show you here. Same companies, you'd have over $4 million in a Roth IRA, tax-free money. And the opportunity's happening again. So now the question becomes, at what price should I be buying those five stocks? What's the buy-in price? If they pull back, when they pull back, where should I buy in? And that's all done by doing some analysis, by taking their PE ratio and adjusting it down and creating a PEG ratio of 1, and then transferring that and into an equation, an algorithm. It'll tell us what price we should be buying those five stocks at today, tomorrow, next week, next month. And as it changes, if we structured this algorithm right, and we have it at our access, at our fingertips, every morning we can get up and we can say, well, that's the price we should be buying Amazon at. It's all in understanding and accessing the data, then interpreting the data so that you can make a better investment. Let me take you to my computer where I've built this projection screen, and I analyze about 60 stocks based on past and future data that I've been able to buy and then analyze and present to you. Let's take a look at it. Okay, this is the spreadsheet that I've created. I call it my 3-year stock price projection. And what I've done is taken the metrics that I'm able to purchase on 60 stocks, and I'm sharing them with you here. It's all built around this column here. What is the 3-year earnings per share average growth on these 60 stocks on an annual basis? Using Apple as an example, the analysts in Apple are saying they're going to grow their earnings per share at 11% average per year over the next 3 years. Why is that important? Because that's why companies are in business, to make profits, which translate into earnings per share, and they're projecting they're going to grow at 11%. And as you can see, that's okay, but AMD is growing at 40%. And then we have here, Intel is saying if they get their shit together, they're going to grow at 228, and Iran at 242. So that's all wonderful, but and based on that, we'd have an easy decision on what to spend on. But we have to then build into that equation, how does that growth relate to their current price? And that's in PE ratio. Apple's PE ratio, price to earnings, is 32. But here, where we were talking about 199 on CRDO, their PE ratio is 151. So to recapture the price of the stock through the earnings per share, it's going to take 151 years for you to regain the price of the stock in the form of earnings from CRD, where it's going to take 32 years from Apple. So let's compare apples to apples, huh? Okay, so that confuses the matter a bit. How far does it confuse it? Well, that's saying at 11 and 32, Apple's PEG ratio is 2.92. That means it's overpriced, because a PEG ratio of 1, if Amazon's earnings were growing at 11% per year over the next 3 years, and its and its PE ratio was 11, its PEG ratio would be 1. Okay? Now you're going to see there are some stocks growing at 18.3, and its PE ratio is 7. Its PEG ratio is 0.42, meaning it's grossly underpriced based on the information that we have at hand. So with that in mind, I want to say, okay, how can I use that information to help me determine what is the fair price of Apple, Google, Amazon, Microsoft, Meta, over Apple over the next 3 years? And what it tells me is if I will reduce Apple's PE ratio to 25, that will then give me the price that Apple is fair priced at with a 25 PE ratio, okay? So it's currently selling at $253.84. Its fair price, based on a PE ratio of 25 and earnings growth of 11, its fair price is $241.19. Now that will change, but that's the beauty of it. So will this chart. Now, okay, let's look at Amazon. Amazon has a growth rate higher than Apple's of 20.7, but look at its PE ratio. It's not 32, it's 45. So its fair price is $180.82, and its current price is $230. Now, if they come out with their earnings in the future and they say, hey, because all the money that we have spent on buying GPUs and building those data centers, our earnings aren't going to be as good as we thought they would be, and thus this number comes down, Amazon, then this number will change as well. So, but you can come here to this sheet, and that's all decided for you. Okay, let's look at another one. Go down here and go to, that's Google. Google is currently selling for $197, and its fair price is $254. Why is that? Because Google's PE ratio is very close to the correction PE ratio I've put in of 25, and its earnings are higher than that of Apple, so it gets a higher price. As you can see, it's actually selling at a 29% discount on my calculations. Now let's go to, this is Meta. It's selling at a 12% discount. Its fair price on Meta is $622, or its current price is $622. Its fair price is $702. Again, why is that? Its PE ratio is in line. Its earnings are higher than Apple's, and thus that brings the PEG ratio down substantially. It would be if we divide that 13 into 25, it's below the 2.15, and that's why Meta's fair price today is $720, and it's selling for $622. Okay, now let's go to Microsoft. Its fair price is $411. Its current price is 650. So it's selling at a premium. Again, that's because we're reducing its PE ratio from 32 to 25, which is fair, which will bring down its PEG ratio. And so that's how we come up with what's a fair price. Now, what I then do is I rank them all according to what their discount or their overprice number is. Now, the other thing that I want to share with you is, let's say you say, okay, I want to consider buying in more of Google. No, I want to share with you Micron. Micron is my number one stock. It's selling at a discount based on, and look at this, it's projected to grow its earnings over the next 3 years at 204%. It's got a PE ratio currently of 11.46 and a PEG ratio of 0.06. So if we put the same metrics to it and we raise its PE ratio to 25, and it now is selling at a discount, its current price is 110. Its fair price is 1,220. Now, here is the cool thing. That'll change. That'll all change tomorrow. And that's because Micron is coming out with their earnings this evening. And what I will do is I will ask Samantha to go in and listen to that earnings call, and then take all the analyst articles tomorrow morning relative to that earnings call and give me a 15-minute podcast explaining to me what happened and why these numbers changed, which they will change tomorrow. Okay? And I do that on every stock. And I ask Samantha to go in and gather that information and then share it with you. So you come to this website and you can get current information relative to Micron's price or any of these other stock prices on a timely basis. Now, what is going to happen in the future is I will be able to program Samantha, my AI agent, to do it for every stock on the stock market. And you'll be able to come and see who's fairly priced, who's unfairly priced, and who has some tremendous growth opportunity in front of it. I mean, look at some of these things. CRD are going to grow their earnings by almost 200% a year over the next 3 years. Micron 204. Here's Skywater. Skywater, if you know Skywater, it's up, I think, 30% today. Why? Well, it has a lot to do with, and if you'll listen to the podcast over here, they're the company that are making semiconductors here in the United States for our military. Okay? We can't have our semiconductors made in Taiwan or in Korea. So the Department of Justice, the Defense Department, has said, who has the ability to make them for us? Well, that company up in Minneapolis, Minnesota, who has a foundry, and then that other one that's down in Orlando, that's Skywater as well, they can make them for us. And that's why Skywater is up. And that's why I own about 5,000 shares of it. And so do my tribe. So that's how this works. How do you get into this? Well, you can do what I do, spend about $20,000 a month to get access to this data, to buy access to an AI agent, and then to have support to run this website and everything around it. Or you could come to this website, bestofusinvestors.com, sign up to have access to all this for a whopping $19.95. And wait! Don't jump in without knowing what you're getting. Take 14 days. Play with it, work with it, see if it makes sense, and then make a decision whether you want to cancel your credit card or not. What is this worth? Well, let me give you, I spent about 20 years in the finance industry. This is financial analysis. I couldn't do this when I worked for Ameriprise because the data wasn't available. But if I could have, and I wanted to work for them for analysis, in today's price, I could have asked for $500,000 a year and then ask for a bonus for every percentage of 10% for every percentage point that I beat the S&P 500. And right now I'm kicking their ass. because of companies like Skywater and SoundHound and NVIDIA that I've been investing in that's kicking the S&P 500. Even though the S&P 500 is up 25%, I'm doing better. Okay, take a look at this. Come to Best of Us Investors. Click on the free 14-day free trial and see if this can't help you become a better investor and beat the S&P 500. Gotta go. Got some work I got to do this afternoon. I got to work on another dimension of this chart that I'm working on, but I'll talk to you about that at another time.